I know we'll see you again soon. Thanks a lot.
Thank you, Stuart.
You got it.
You got it.
Let's back to the markets, please. Just to make sure of this, the rally is still very much in place. Mike Lee joins us at our market. You're fortunate to watch looking at the market today of all days. We're up 900 on the Dow Industrials. When does the market? Oh, is this rally for real?
You know, Stuart, it's obviously up today, but I don't think it lasts. There's just too many overhangs, too many problems that need to be solved.
Like what?
So earnings for the fourth quarter, at the end of June, the estimates were for 9% growth. Now we're looking at negative 1% growth. This quarter, without energy, earnings will be down 5.3% year over year. And all of these Fed rate hikes basically haven't hit the economy yet. There's a 3 to 6 month lag, and it was only about 4 or 5 months ago that we started jumping in 75 basis point increments. Okay, that housing rolled over earlier this year, manufacturing rolled over. All these things are going to come to a head near the first quarter of next year.
So the first quarter of next year is when it's at its worst, so to speak. Like the economy is doing badly, and the Fed has been raising rates. So the bottom point comes in the first quarter of 2023, and after that, then what?
Yeah, so I think around then, it's going to look really ugly. And you're going to have every doomsday person that's been predicting the epic depression since the last financial crisis, like Nouriel Roubini, will see, look, I was right 14, 15 years later. That's when you really want to buy stocks. And you want to look for that Armageddon type period to look for that. And I don't know how much stocks are going to be down from here. They could be down 30%. They could be down 3%. But I just think until all these issues are solved, for us to break out to the upside, it's just going to be difficult.
But you know, some people would argue that we hit bottom before the midterms, but when the market was really selling off consistently. That was not the bottom, you don't think?
It's hard to call the exact bottom, but look, estimates for the S&P 500 earnings next year were 240, or close to 250. Now we're down to 230. I think they get closer to $200. And if you have a 10-year Treasury around 4.5%, what kind of multiple can you put on that? 15, 16. That's an S&P 3100, 3200. So it's to me. It's very, very difficult to say this is the end, this is it, because for us to kind of get back to these easy money multiples of 18, 19, 20 times earnings, it's going to take a long time for the Fed to move down, because the risk that the Fed runs now is if they are not hawkish enough now and we are in a deep recession next year and inflation comes up again, do they really want to be super hawkish in the middle of a deep recession?
No is the answer to that one, and let's hope they don't. We liked you when you were a Super Bowl. We like you when you're an honest man about this, too, and we appreciate that.
We love you too, Stuart.
Oh, yeah, okay. Mike Lee, you're all right. Thanks very much indeed.
Thank you.
Let's get to the movers, and let's start.